All these Midwest markets are getting some industrial investment too, and that's going to create some job growth. Right outside Columbus, Columbus is top for rent growth, and then they're getting that big $20 billion chip manufacturing plant. Right, that's gonna really help that market. It's gonna lead. I was reading, it was a post by Carl Whitaker, friend of the pod.
Friend of the pod. I saw that too. It was a good post.
And he was talking about these Midwest markets like they're maybe the next Sun Belt markets. Like, nothing gives me goosebumps.
He's like there are quite more and more Midwestern markets that have like Sun Belt like growth, job and population growth, but you're getting a huge discount from the cap rate, and because just the markets aren't overcrowded with investors, but there's just enough liquidity in those markets to make deals happen. One big hit from institutional players will say, those markets, maybe Columbus is becoming a little bit more institutional now, but like Indianapolis and Kansas City, Louisville. There's not the perception is there's not adequate liquidity. I've never known of a deal where liquidity was an issue in Indianapolis. It's always been able to trade. There's some big deals that are on the market right now. They're going to trade.
Oh yeah,
they're going to trade.
Maybe we'll buy one. I always joke about and they're going to bring in the New York guys, and then they'll buy them up and.
But
there's an appetite for it, and that's why I always kind of kid with our analysts and stuff is because it's not like people aren't noticing these smaller markets either. So at the same time that it's growing, there's an increasing amount of attention that's being paid to these markets. And I just really like that post that Carl made there. Yeah,
often you'll hear markets in the Midwest. They don't boom, but they don't bust. So they're just stable. What Carl Whitaker is pointing out is that what's happened is that they didn't boom as much as some markets, but they did boom.
They enjoyed it.
But they also didn't bust. And so it's that combined compounding growth is what really adds to stability, not to mention just the fundamentals.
And that's something that we were tracking when we tracked like rent growth and the stories of these different markets. Like one of the stories was, San Francisco that didn't do well and hasn't really continued to do well. Another one was New York that really sank and is coming back, or Phoenix that was in the high and now it's on the lows. Well, the other story is markets that were a little bit high when everyone was else a skyrocket, and now they're still a little bit high. So that steadiness is really come to the benefit now, especially during this kind of uncertain period. It's gratifying, I guess, for Midwestern investors, and it may lead to cumulatively the Midwest may be the biggest gainer.
Exactly. So just quoting Carl's post, interestingly enough, the Midwest relative outperformance in those down years, 140 basis points, generally tends to be larger than the gap in underperforming years, 100 basis points. The difference is, of course, those stronger years only come around once in a while. If you think about this in more academic terms, reflect back to a real estate cycle quadrant-like chart, like the one posted in the comments. While most of the rest of the nation deals with hypersupply, period, the Midwest is closer to supply-demand equilibrium, and that manifests is in the form of stabilized occupancy and essentially normal rent growth. So, again, you call it boring, in the Midwest, but cash flow is not boring, Matt. Or it's okay if it is. I don't call it boring. I call it great.
And it's interesting that we might be at this moment before everyone jumps in, because the way that he's talking about it and the way that I've understood some of these quadrants is you pass through phases sometimes of like hyper supply and then you're in your Baroque period or whatever it is. Stagnant, and then you go and you grow again. But we may be timing this really, really well right now.
Yeah. No, I agreed. So that was year-over-year numbers, Matt. I'm looking at the Yardi chart, just more real time. Month over month, the Midwest still is dominating. Month over month rent growth for all asset classes. Topping the list is Columbus, Ohio, followed by Orlando, Seattle, Charlotte, Indy, and Kansas City. Lifestyle assets, this is more A-class stuff. It's Columbus, Orlando, Charlotte, San Diego, Seattle, and Kansas City. But for month-over-month rent growth, renters by necessity asset class, this is your more workforce housing. Indianapolis tops the chart, followed by Las Vegas, Phoenix, Denver, and Kansas City.
Huge difference between the lifestyle and the renter by necessity. The top five are a whole lot different. Kansas City is really the only one that shares between the two of them. That's really interesting.
Yeah, it is. Transacted rents, renewal rents, Matt, continue to fall. So I think that's just kind of coming back in line with market, which was you probably signed some leases, year and a half ago, pretty high rents. Now the market's lower. Can't really renew somebody for higher than market because they just go get a new lease.
Now this renewal rate, they said that means monthly lease renewal rate means that 67.4% of people in Indianapolis renew the next year.
Yes.
It seems like I don't know what
Indy's got. I didn't even see this earlier until now, but Indy's got top year-over-year renewal rent growth as well at 8%. San Diego, Orlando, Kansas City, Miami coming in after that, all pretty close. Fascinating.
Yeah.
I mean, again, like I know, Matt, we come off as we're talking about the Midwest and Indianapolis all the time, but the data keeps forcing our hand. I mean, we're not like we're not even searching for it. And we are very fortunate to
this
be
is
in
what
a great market.
I was going to note, too, is they sometimes will have special kind of focuses, different areas that they focus on in these Yardi Matrix monthly multifamily reports. And this time they talked about just what we talked about earlier, which really covers the same type of stuff. Is people are extending and they are almost like no longer pretending. I read this. There was something.
It just is what it is.
Yeah, it was. I don't know where the article was specifically, but it was like, well, all you got to do is survive. And maybe it was something that you said or something. If you just survive, then you're going to be fine. Well, it's like
I would have said not just we can't just survive.
Yeah. But
we have to find a way to do more than survive.
Yeah,
we're not surviving. Thriving.
Yeah,
to make it happen.
That's right. If you scrape by, but the point is, a lot of people
that
are
has been the mentality
by.
of like if you can get through this year, if you can get to 2025, a lot of that is because they think interest rates will be lower, or the supply shock will be mostly done with. That's gonna be a little bit later than
it's almost like if you're the last one that survives, it's almost this idea of like, well, everyone else fell away.
It's like Hunger Games.
Kind of like that, where you reap the spoils of everyone else. But I don't think it's gonna be like that. I think if you survive, you're gonna be worse off, and it's not gonna be so great if you're surviving, and you had to really scramble and compromise a lot of things.
I think if you're just surviving and hanging on, then I would agree with you. Then in 2025, you're not gonna be doing that great because you're literally just going to be fighting and surviving, and you haven't punched through.
And there's enough that have done well.
Yeah, I think there's a lot of examples of groups that have continued to buy, some at prices that I think they've overpaid. They might be able to get through that, though, if they can get to the other side. If they put the right type of debt on it. But then also in the last really 9 months, there's been opportunities that have popped up, and there have been deals. And those are the deals that are going to turn into like the war stories of, talking in 2027, 2028 of like, we got these just incredible deals, in the whatever we're going to call this. What are we going to call this, Matt? We talked about this last week.
Oh, yeah.
Because it's not COVID. It is like the COVID COVID hangover. That's too long.
Yeah, I don't know.
I've heard ZERP being referred to like the crazy run up in prices and everything. But what is this? What is this?
Hangover period.
Just hangover.
Hangover period means that it was good before. It wasn't necessarily that good.
Well, so it got kind of good. It kind of got good there for a minute there. I mean,
for multifamily
30% rent growth and 4% cap rates was, like a drinking binge. It was too much and unsustainable.
Yeah.
Was it a good time? For some, it was a great time.
Yeah. You got to pay for it.
If you were the designated driver, you're like, okay, well, at least I'm around, but I didn't get to go out and do that much. I don't know, man. That's not a good analogy. We appreciate all our designated drivers.
I got to come up with a better term, maybe.
I think so.
But yeah, if we want to jump to the Real Page article, it's very short, but it is impactful, I think. And it's like, well, they're saying it. That's all they got to say is this one sentence, which is their headline that they are strengthening their forecast in most markets based on economic indicators. That means they think that rent's going to go higher than they used to think.
Well, I think rents already have gone higher than they thought it would at the beginning of this year. We're in the first inning of the leasing season, and things are looking a little bit better than many had originally anticipated for this year.
Yeah,
we're going to be repeating a lot of names, but their forecasted rent changes for the year ending of 2024 Let's go at the laggards below 1%. It's going to be Austin, Orlando, San Antonio, and Tampa. I'm not going to read this whole list between 1.9 and 1. You've got markets like Atlanta, Charlotte, Dallas, Fort Lauderdale, Fort Worth, Houston, Jacksonville, Vegas, LA, Memphis, Miami, Nashville, Oakland, Phoenix, and some others. Between 2.9 and 2. This is like, okay, you guys are basically doing, kind of the average.
The former list was all Sun Belt, almost all of it except for Seattle. Sorry.
Correct. Yeah. all Sun Belt, and we'll say all Sun Belt coast and coastal.
Yeah.
Or just, no, you're right. And then so between 2 and 2.9, which I'd say is, more of your typical average growth, maybe a little bit subdued. But you've got markets like, these are a lot of the northeastern markets, Matt. Mm-hmm. Baltimore, Boston, Cincinnati, which is obviously Midwest, Cleveland, Denver, Greensboro, Kansas City, Milwaukee, Minneapolis, New York, Philly, Pittsburgh.
A little more Midwest.
Some Midwest, some Northeast, all good. But in the 3% or higher, they're growing beyond what you typically see in an average year. Markets like Anaheim, California, Chicago, Columbus, Detroit, Indianapolis, and San Francisco.
Wow. Well, they're really plotting a recovery for San Francisco.
I would hate
nice.
to think that, Matt, we are unduly influencing the Real Page team or Carl Whitaker. I think they're a little impervious to our influence. But if anything, I think that we appreciate Carl coming on the show a couple weeks ago. If anything, I mean, my comment, this is not to Carl, this is more just the industry many years ago, is that you guys aren't even looking at this. You guys are just ignoring it. And I'm not blaming anybody or anything, but, and again, I've told this story a handful of times, Matt, but I think back to pre-pandemic real estate conferences and going to the big ones like NMHC. And when they would talk about the economy, they would talk about markets. Yeah, they're not the only markets they would really talk about and spend, if there was an hour speech, 25 minutes would be on the Sun Belt. My math's going to be off. 20 minutes is spent on, the coasts. And then, 20 minutes was spent on, some primary markets. Then 5 minutes was spent on the Midwest, if that adds up to 60. Yeah. So little
it's over,
time.
But that's fine.
Yeah, I need an expel.
They don't even have time for Midwest. That's what you're saying.
Literally, they're like, I'm over time. I was supposed to talk about the Midwest, and these are some Midwestern markets that exist. That was what I was. What I was going for from the beginning. They just didn't talk about it. And so if you were one that was there, and you're like, I'm trying to put together my investment thesis, I don't even know these parts of the country exists. Yeah. And I've talked to many investors, especially international investors, but investors in the U.S. who are like, what's going on there? Sure, I've heard of it, but why? I don't know anything about it. Not that they really know anything about Raleigh, Durham, other than someone's like, oh, there's a research triangle there. It's great, a lot of got great research that's going on, and it's Sun Belt and it's tax friendly and all that. Okay, that all sounds good. Not to diminish, get Raleigh, Durham, and all that story, but there's a lot of other markets. There's some interesting stories going on that just people didn't know about. Yeah, and so it led to a concentration of investment and overinvestment in certain markets and more healthy balance in others. And I think that. I remember when Paul Fiorello from Yardi Matrix, who put the Yardi Report, reached out to us. This is less than around a year ago after he came on the show for the first time. And he said, he's like, Indianapolis is popping up. He's like, what's going on? He's like, explain. He's like, explain to me. Tell me about Indy. Why is it performing so well? No one had really taken the time to, in the national apartment research, media, whatever you want to call it, no one had really taken the time to do the deep dives because it was focused on Nashville and Atlanta and Phoenix and Boston and New York and LA. And so I think that when they couldn't ignore it, when you're on the top, when the Midwest or region dominates the list for a year, you have to start digging into it a little bit more. And it becomes a factor in a player.